Thank you for taking the time to join us for our company's financial results briefing for the first quarter of fiscal year 2025. I am Sogo, CEO of AnyMind Group. I will now proceed with the presentation. First, I will share some highlights of our financial results. In the first quarter of fiscal year 2025, we continued stable growth, with revenue reaching 12.6 billion yen, a 20% increase compared to the same period last year, and gross profit reaching 4.8 billion yen, a 26% increase compared to the same period last year. Operating profit was 298 million yen, a 16% decrease compared to the same period last year, but we continue to maintain operating profitability despite it being a low season in terms of seasonality. Adjusted EBITDA was 726 million yen, an 8% increase compared to the same period last year. This slide summarizes today's presentation. In the first quarter, we maintained a stable growth trajectory, achieving a 26% year-on-year increase in gross profit. Looking at gross profit by segment, our influencer marketing business led growth with a 27% year-on-year increase, while our enterprise e-commerce business grew by 53% year-on-year, primarily in Southeast Asia. We also continued to focus on improving operational efficiency through generative AI adoption internally and strengthening solutions for enterprise clients. Recently, we announced the M&A of Vabula, a company operating social commerce businesses, including TikTok in Vietnam, further strengthening our enterprise e-commerce support capabilities. On the other hand, after careful consideration of market environment changes in creator growth business of our partner growth business, we have revised our full year 2025 earnings forecast downward. However, we maintain our growth outlook for our enterprise clients target business, which is e-commerce support and marketing, and continue to expect high growth. Additionally, there are no changes to our medium-term target of achieving 105 billion yen in revenue and 38.5 billion yen in gross profit by 2027, and we aim to achieve these targets incorporating growth through M&A. The core of our growth strategy focusing on expanding enterprise client targeted business, and we will further enhance our support system for enterprise clients by strengthening AI agent implementation support and DX support utilizing generative AI. We aim to become number one in Asia in the corporate support sector. Furthermore, we have resolved to expand our previously announced share buyback program and initiate our first ever dividend policy. I would like to explain the current revision to our earnings forecast. We have made a downward revision of 9.5 billion yen in revenue and 2.5 billion yen in gross profit, representing changes in our forecast of 14.7% and 10.5% respectively. The factor behind this downward revision is due to significant changes in the external environment of partner growth business, particularly in the creator growth business. As background, I will explain our performance growth for the fiscal year 2024. In 2024, we achieved high growth with a 48% year-on-year increase in gross profit, which was driven by the rapid growth of our creator growth business. The slide shows the gross profit of creator growth business, where revenue for short-form videos, a new market, has experienced rapid growth since the third quarter of 2023. For short-form videos, we expanded our target market to support creators globally, regardless of country, and actively pursued creator acquisition. As a result, the year-on-year growth rate of gross profit in creator growth business has significantly accelerated from 18% increase in 2021, 19% increase in 2022, to 69% increase in 2023 and 206% increase in 2024. For 2025, while we assumed at the beginning of the fiscal year that the growth rate would stabilize, we were expecting stable business growth and profit contribution. However, regarding short-form videos, the business environment has changed significantly recently, with revenue unit prices dropping sharply to about 1/4 compared to previous levels in March 2025. This business operates on a revenue sharing model, so when unit prices fall, the revenue of creators we support decreases, and our revenue is similarly affected. In addition, due to the sudden drop in unit prices, we have seen situations where some creators have reduced their short-form video production activities. we assume this is due to the impact of video platforms revising their unit prices, and we recognize that similar changes have occurred not only for our company, but across the global market. As a company, we were carefully assessing whether this unit price drop was temporary, but with no signs of price recovery even in April, we determined it necessary to revise the outlook for our creator growth business for this fiscal year. This is the main reason for our earnings forecast revision. On the other hand, the business deterioration due to the unit price drop has run its course, and based on current unit prices, we believe we are in a position to work toward growth in creator-related business going forward. This is a summary of our revised earnings forecast for the current fiscal year. The main reason for this revision is the significant drop in revenue unit prices for short-form videos in our creator growth business. Additionally, we have made two other changes. Regarding publisher growth support, which is included in the same partner growth business, we have lowered our revenue forecast based on changes in the revenue mix, as web media publishers with low gross profit margins is underperforming, while mobile app publishers with high gross profit margins is performing well. In addition, we have revised the assumed dollar-yen exchange rate for the entire group for the full year 2025 average from the initial forecast of 149.25 yen to 145.3 yen, which has adjusted our yen-denominated revenue and gross profit downward. With the downward revision of gross profit forecast, we have also revised operating profit downward. On the other hand, business improvements through AI utilization are progressing, and we have lowered our SG&A assumptions, primarily for recruitment plans and outsourcing costs. This is the breakdown of our earnings forecast revision. The details of the changes are as explained so far, but due to the change in foreign exchange rate assumptions, there is a revision impact of 284 million yen in gross profit and 258 million yen in SG&A expenses. This represents the compound annual growth rate from 2023 to 2025 based on the revised earnings forecast. Although this is a significant revision, it represents a partial reversal of the rapid growth of partner growth business in 2024. Looking at the average growth rate from 2023 to 2025, revenue has increased by 29%, gross profit by 29%, and operating profit by 53%. Marketing and e-commerce segment are the growth drivers, growing at 26% and 54% per year respectively, while the partner growth business has achieved stable growth of 19%. I will explain the assumptions for the revised earnings forecast for fiscal year 2025. Regarding the year-on-year growth rate of gross profit by business segment, for marketing business and D2C e-commerce business, we expect high growth backed by strong customer demand with no changes in assumptions except for foreign exchange impact. On the other hand, for partner growth business, we are assuming a 15% year-over-year decrease with this downward revision. Regarding M&A in the earnings forecast, we have not incorporated Vibula, for which we announced the M&A in April 2025, and for AnyReach, which was recently acquired, we have conservatively incorporated mainly the increase in SG&A expense. One point to note is that due to the stronger yen and weaker dollar, foreign exchange losses have occurred on dollar-denominated assets, such as US dollar deposits, and we have incorporated 281 million yen, which we expect occurring through the second quarter as non-operating financial expense. Although we have revised earnings forecast of this fiscal year due to external changes in creator growth business, overall the business is expanding steadily, and there are no changes to the medium-term goals announced in February 2025. However, we are assuming achievement of these targets, including the revenue growth effect from M&A. Regarding the operating profit margin, while our forecast for this fiscal year is 3.2%, we aim to achieve 6% or higher within the medium-term target period. Furthermore, if business structure reforms through generative AI utilization progress beyond expectations, we are also considering a scenario of achieving operating profit margins in the 10% range at an earlier stage, and will proceed with company-wide reforms with this in mind. Even in the medium term, we will continue to balance sustainable growth and improved profitability to enhance enterprise value. Our company continues to grow, focusing on e-commerce support and marketing for enterprise clients, and we can expect continued strong demand in both domestic and international markets. In particular, we view the revitalization of trade within Asia against the backdrop of global trade friction as a significant opportunity to further expand our presence in the Asian market. We will respond to changes in the market environment by leveraging our business foundation across multiple countries and our strength in flexible cross-border responsiveness. Here I will explain our revenue growth initiatives targeting enterprise clients. In the marketing business, we will enhance our competitiveness by strengthening our social media analysis and influencer recommendation features utilizing generative AI. In the e-commerce business, we will expand the provision of a hybrid model combining AI live commerce and traditional live commerce in the rapidly growing social commerce and live commerce areas such as TikTok Shop. We will also promote the acquisition of new brands for cross-border e-commerce support, strengthen support systems, cross-sell e-gifting solutions, and provide assistance for enterprise clients in implementing AI and AI agents using generative AI. Additionally, we plan to deepen collaboration with regional clients and expand cross-selling between business units by strengthening our regional sales structure, which provides one-stop support throughout Asia and utilizes support expertise developed in each country. This shows our focus areas for stable growth in partner growth business. Regarding creator growth business, although it has been affected by declining unit prices, we believe the creator economy itself will continue to grow in the future. Therefore, we aim for stable growth by expanding our support areas to include creator production and short drama content creation. For publisher growth business, as the mobile app market continues to grow, we will intensively strengthen this area. Our company is rapidly transforming into an AI native company through comprehensive AI adoption. With a dedicated team reporting directly to the CEO, we're advancing company-wide automation and operational improvements. We're focusing on two key areas: enhancing internal processes through AI implementation and developing customer-facing AI agents. These initiatives are expanding globally from our successful Japanese operations. For example, in our Japanese influencer marketing division, AI now powers sales processes, including requirement analysis and proposal creation. In delivery workflows, it handles influencer selection, content review, and reporting. For back-office operations, AI manages meeting transcription, translations, and compliance checks. We have confirmed efficiency improvement potential of around 40% in this business processes, with further improvements expected in the future. We are now scaling these successful models to all global locations, with over 100 AI-driven business transformation initiatives currently in progress across our organization. I want to clarify our company's path to achieving our 2027 medium-term goals. While there's currently a gap in our financial forecast, we believe this can largely be resolved through strategic M&A and AI-driven efficiency improvements. Our calculations show these initiatives will reduce the gap to just 5.9 billion yen in revenue, representing 5.6% of our target, and 600 million yen in gross profit, about 1.7% of our target. This small difference can easily be covered by organic growth alone. For M&A, we project 3 deals annually from 2026, each conservatively estimated at 1 billion yen in revenue and 300 million yen in gross profit based on past performance. Regarding AI implementation, while we've identified potential for 40% company-wide operational efficiency, we've incorporated less than half of this in our projections. Even with these conservative estimates, the combination of M&A and AI significantly narrows the gap to our targets. Our management team is highly confident in meeting our medium-term goals, with potential to exceed them if either M&A or AI initiatives outperform expectations. We remain committed to enhancing corporate value through core business growth, with M&A and AI as our key drivers. I will now explain the summary of the consolidated financial results for the first quarter of fiscal year 2025. Revenue was 12.6 billion yen, and gross profit was 4.8 billion yen, both showing growth compared to the previous year. The indicators below operating profit have decreased compared to the previous period due to continued growth investments. In addition, net income has been affected by the recording of 146 million yen in foreign exchange losses on US dollar-denominated assets as a non-operating financial expense due to the strong yen and weak US dollar exchange rate fluctuations. For this quarter, the progress rate against the revised full-year forecast is 23% for revenue, 23% for gross profit, and 17% for operating profit, which are levels exceeding the same period of the previous year. Net income shows a lower progress rate due to the impact of foreign exchange losses. This slide shows the quarterly performance trends. For the first quarter, revenue increased by 20% and gross profit increased by 26% compared to the same period of the previous year, progressing as expected in line with seasonality. I will now explain the regional performance results. On a gross profit basis, Japan and Korea account for 49%, Southeast Asia accounts for 39%, and the Greater China and India region accounts for 12%. Regarding the growth rates shown in the graph on the right side of the slide, Southeast Asia is particularly notable with a 42% increase compared to the same period of the previous year. In Southeast Asia, all business segments are performing steadily. In Japan and Korea, marketing business is maintaining growth momentum, while in Greater China and India, partner growth business is maintaining growth momentum. Operating profit for the first quarter is 298 million yen, decreased by 57 million yen compared to the same period of the previous year. Adjusted EBITDA increased by 54 million yen to 726 million yen. I will explain the trend in SG&A expenses. In the first quarter of fiscal year 2025, the ratio of SG&A expenses to gross profit increased to 94%, which was due to continued investment in recruitment in growth areas, and gross profit in creator growth business fell below expectations. Going forward, we expect that the increase in recruitment investments and outsourcing costs will be mitigated as operational efficiency improvements progress. Our company has established gross profit per employee as an important indicator for measuring profitability improvement. In the first quarter, we continued to make improvements, but due to the slowdown in growth rate of creator growth business and other areas, the increase in gross profit per employee was limited. This shows the status of our balance sheet. In the first quarter of 2025, we raised additional interest-bearing debt, which was allocated to M&A funding and other purposes. Also, by the end of the first quarter, we completed making AnyReach a subsidiary, and the goodwill to net assets ratio maintains at a safe level of 0.21 times. Although our cash on hand has decreased due to M&A activities and the strong yen-weak dollar effect, we continue to maintain a sound financial foundation. Today, we resolved to increase the upper limit of the total number of shares that can be acquired, regarding the share buyback resolved on February 14, 2025. The number of shares to be acquired represents approximately 2% of the total issued shares. We have also resolved to change our dividend policy. In light of the transition to a stable profit generation stage of our business, we have decided to implement our first dividend payment. The forecast for the year-end dividend for the fiscal year 2025 is 2 yen per share, and we aim to provide stable dividends while continuing growth investments. We believe that initiating dividends may contribute to improving stability as an investment target, reducing stock price volatility, and expanding our investor base with the goal of building trust with shareholders and achieving sustainable growth in enterprise value. We have received many inquiries from investors regarding the impact of tariff policies. At present, we have no basis in the US market and have almost no revenue directed toward the US. So we do not anticipate any direct impact from US tariff policies. While we are closely monitoring the indirect effects due to the risk of global economic deterioration, we currently do not see any specific negative impacts on the Asian market. Rather, we view the reignition of the Asian trade market due to trade friction as a new business opportunity, and will leverage our multinational business presence and foundation as a strength to enhance our ability to respond to market changes and competitive advantage. While there is a decline compared to the previous quarter due to seasonal factors, all business segments are showing growth when compared to the same period of the previous year. The gross profit margin for the entire group is 38%. which shows no significant deviation from past trends and continues to remain at a stable level. The composition ratio of gross profit by business segment is 45% for the marketing business, 20% for the D2C e-commerce business, and 34% for the partner growth business. All the business segment continued growth trend, but the D2C e-commerce business in particular is showing a higher growth rate. The marketing business has achieved stable growth with a 21% increase in gross profit compared to the same period of the previous year. Growth continues particularly with influencer marketing as its core, and it is performing steadily in both the Japanese and Southeast Asian markets. Regarding the growth rate of gross profit by region in the marketing business, Japan and Korea with a 19% increase and Southeast Asia with a 23% increase are showing steady performance compared to the previous period. The Greater China and India region was flat compared to the previous period, affected by reduced digital marketing budgets in Hong Kong, but currently influencer marketing and China inbound and outbound business are driving recovery. While cosmetics and beauty account for the largest share at 26% of marketing customers by industry, our client base is widely dispersed, and we are chosen by a diverse range of customers. In February 2025, we were certified as a top partner of Red, a popular SNS in the Chinese-speaking region boasting over 300 million monthly active users. Our platform AnyTag has also begun supporting Red influencers, and we are steadily increasing support projects as an advertising solution for inbound and outbound marketing from China. D2C e-commerce business grew by 37% compared to the same period last year. Our enterprise D2C support business continued to perform well, increasing by 53% year-on-year. Creator D2C showed stable growth with a 22% increase. DDI in Indonesia and Archie in Malaysia, which were acquired through past M&As, are performing well, with other Southeast Asian operations driving growth. In addition to the increase in gross profit margin of the Creator D2C business, the overall gross profit margin improved due to better profitability in Japan and Indonesia, which have large-scale gross profits in the enterprise client EC sector. This shows the trend in the number of e-commerce brands handled and revenue per brand. For Creator D2C business, it was the low season, and due to resource concentration, the number of brands slightly decreased, but revenue per brand has maintained the same level as the previous year. For enterprise clients, the number of brands has increased, primarily in Southeast Asia, but since the sales scale of new customers is not yet significant, revenue per brand is showing a slight increase compared to the same period last year. Recently, we announced that Vibula, a company operating in the e-commerce sector in Vietnam, to become our subsidiary. This is our 11th M&A, the 4th in the e-commerce sector, and the 1st in Vietnam. Vibula is a leader in live commerce in Vietnam, and we aim for further business growth by combining their operations with our technology. Vibula is expected to contribute to our consolidated financial results from the third quarter of this fiscal year. We anticipate that live commerce will penetrate not only in Southeast Asia, but also in Japan in the future. So we would like to accelerate the strengthening of our live commerce support system globally. In February 2025, our high performance and live commerce operational capabilities in TikTok Shop Thailand were recognized, and we were certified as a Prime Partner, the highest rank. In Japan as well, in anticipation of the expansion of the social commerce market, we will develop social commerce support by leveraging our achievements, know-how, and technology cultivated in Southeast Asia. We are also advancing product enhancement through generative AI utilization. We have implemented AI agent customer service features in our conversational commerce platform, AnyChat, and added dynamic graph generation capabilities to AnyAI. Next, I will explain about partner growth business. This business has achieved stable growth with a 25% increase compared to the same period of the previous year. In creator growth business, we have transitioned from the rapid growth seen in the previous period to a stable growth trend. In publisher growth business, growth has slowed due to a decrease in web advertising unit prices, and we plan to focus on publishers operating mobile apps going forward. Contracts with mobile app publishers are increasing, primarily in Japan. Despite decreased revenue per publisher due to overall market decline in advertising unit prices and an increase in small-scale clients, the gross profit per publisher has only slightly decreased thanks to increased portion in higher gross margin mobile app publishers. Regarding the number of subscribers to our creator platform, since March 2025, due to the industry-wide decrease in revenue unit price for short-form videos, there have been a certain number of creators who have reduced their short-form video production activities, resulting in a decrease in the number of supported creators, mainly in Japan and the Greater China region. In partner growth business, taking into account the recent changes in the business environment, we are enhancing diversification of revenue models to avoid dependence on specific revenue models. In publisher growth, we are strengthening the deployment of our self-developed casual game apps with advertising revenue models and support for mobile game publishers based on this expertise. In creator growth, we launched the short film channel Shunkan Seiju, featuring our contracted talents. In just 1 month, it surpassed 40,000 followers on TikTok, and we are also steadily acquiring brand sponsorship projects. Due to changes in the external environment, we have to revise our earnings forecast downward for creator business this fiscal year. We sincerely apologize to our investors for this situation. On the other hand, as a business foundation, important initiatives that will serve as future growth drivers are being strongly promoted, such as the progress of business efficiency projects utilizing generative AI and strengthening support systems for enterprise clients. And we believe that the enhancement of our medium to long-term revenue base is being steadily realized. We will use this situation as an opportunity to evolve our organization and business model to become even stronger and sustain the business growth. Thank you for your attention.